All right, great, folks. Thanks for joining me, and we're going to get started right on time. I think all of you can see and hear, and if otherwise, I'm sure you'll let me know. I see a great crowd jumping in. I see, wow, a lot of people all at the last minute here. It's always kind of fun to watch that. But with that said, we will go ahead and get the show on the road, and we're going to talk about trading options using automation and technology. We're going to talk about some high probability option strategies and looking at one-touch trade alerts. I think this is going to be something very unique and something you've never seen before. All right, very good. I had a few questions already, and that's fine. You can always use that box for questions, and I'll probably answer a lot as we go along, but in the meantime, we'll have a Q&A at the end. So with that said, let's talk about speculation. And of course, we're looking for prices to move up, down, and sideways, and we're trying to make money. We're trying to profit on this movement, or sometimes lack thereof. And there's always risk when we're doing that. So it is important, and let's take a look at that risk disclosure. Some of you are familiar with this, probably most of you, but do read through that. Give you a brief moment there. All right. All funds committed should be risk capital, and past performance is no guarantee of future results. So with that said, let's look at auto-generated options trading. It's something new for probably most of you. These are pre-built option spreads. You never have to struggle with trying to build an option spread. We mentioned one-touch trade alerts, that automation for risk and profit management. And we can apply this type of technology with bull markets, bear markets, and non-directional strategies. So if you like what you see towards the end, we're going to show you how to get involved. We're going to give you a special offer here. It's worth over $21,000, and that's no hyperbole. And we're going to show you how to get on board and join us at an enormous discount and even at no cost at all. Everyone's favorite word, free. So the goal here is to avoid this poor trader here struggling with orders. We want to end up like this robot. And we're going to learn how to trade that chop, as they call it, or the chop bucket. So how would you trade a market like that? We're going to give you some ideas. And do you always want to be bullish? And here's one reason I think it's important, now more than ever, markets are at, making dramatic all-time highs, it seems, every other day, and it's probably going to keep up that pace for a while. Who knows? But that might be the way for quite a while here yet, as long as the Fed continues with their policies. But look at this forecast, Jeremy Grantham, someone to pay attention to. He says here that in the next 7 years, stocks will generate a negative 8% return for the large cap stock indexes, small cap negative 8.5%, and bonds will be negative too. So something to look to in the future. Maybe he's right, maybe he's not. We don't know, but that's why we like options and what we're going to show you to help diversify. And a little bit about who we are first, and we'll get into the demonstration. People always want to know who we are and what's our background. So there's yours truly down on the trading floor with some of our options traders several years back. We are AltaVest since 1997. We've been doing this a long time. We're a brokerage firm, and all of our staff, of course, are licensed with multiple decades of experience. Some of the other outlets and venues perhaps that you've seen us on in the past. In fact, here's Market Watch. We often get quoted. Here's just a comment from just a few weeks ago about gold. You can see here, quoting us here at AltaVest, our thoughts on the gold market. So it's always kind of fun to find yourself in the press. And just so you know, we are regulated by the NFA and CFTC, and we are located in California. So those are the logos for the regulatory agencies that oversee our industry. And we've traded millions and millions of futures and options contracts over the years. So I think that qualifies us as somewhat of an expert in the space. And with that said, we're trying to convey that expertise and that experience to you. And you don't want to end up like this mad scientist here trying to figure out all the structures in the markets and any patterns and so forth. I think we can help you with the trading solution that we're going to talk about with decades of input and development over the years. I think we're going to have a good time here as we run through the demo. And just a little bit about myself. I'm Eric Gebhard, doing this about 30 years now. I'm a co-founder of AltaVest, and I have my Series 3 license since 1991 and my BS in Business Administration from the University of Southern California, so USC Trojans. And I often do webinars and presentations, and for example, some you may have seen in the past and perhaps not. Either way, that's fine, because we're going to have a good time here. And oftentimes people will get on the phone and we'll talk and say, well, how did you get interested? Well, here you go. I was at USC. We were in our business school. Here's my investments textbook, and that's my book there, Studying Options Markets. And that's what piqued my interest. You can see all my notes. And yes, that is absolutely my book. I found it actually about 2 or 3 years ago on a bookshelf that I totally had forgotten about. So I thought it'd be kind of fun to pull it out. And there you have it. At the time, we were looking at the oil fields in Kuwait blowing up and crude oil prices doubling and gold prices were jumping. So that was the background in which I learned about trading futures and futures options, although in a very academic sense. Of course, you can be book smart, but how do you apply it? And that's what we're going to talk about here, how to apply this type of technology for trading options in a real world environment. I had my securities licenses, multiple licenses early on, but I ended up just really being more fascinated with futures, and that's where I ended up. So with that said, we're going to jump into 3 common barriers for traders. I want you to kind of, as we go along here, make comments or chat or whatever you like, questions. Tell me if you agree or not with what we're about to jump into real quickly, and then we'll jump into that demo. And actually what I'm going to do here to give us more screen space, I'll shut off the webcam and we'll go ahead and just jump here to number 1 of these barriers. This was interesting. This is something I thought I had to put in here. 2/3 of adults who've been investing for less than 3 years use social media to make stock trading decisions. So how many of us can relate to that? Maybe you can or maybe you can't, but I don't think that's a really smart idea in the long run. So I think that's what they call selling a story, pushing a narrative. This made me laugh a couple months ago. The whole AMC meme thing was, I don't even quite understand how this even happens, but they're having pool parties pushing the price of AMC stock to the moon. Pretty ridiculous, but that's what's out there. And here's something too. There's less than a 1% success rate when day trading. This is from the Journal of Financial Markets. And this is several years ago, I think 2014 maybe, but I think it's probably still applicable. I can look for a more up-to-date study, but ultimately it says less than 1% of the day trader population is able to predictably, reliably earn positive abnormal returns net of fees. I think a big problem there is, of course, most people have a bias to always buy something. And that works great when you're in a relentless bull market like we have been. But even so, are you really, beating the indexes? And of course, if you're day trading, you've got to put your time in, you've got to stare at that screen, but I don't think you want to end up like this guy here. I think there's something like 50 monitors here this guy's monitoring. That picture always makes me chuckle. So number 2, will you actually beat the market? We kind of mentioned that. So here's this fortune teller here. He's going to tell us to buy, sell, or hold or trade. But remember, if you're trading, you're just typically buying stocks is what most people end up doing. You've got to pick the correct market, direction, strategy, your timing, your entry price, and then of course your exit, which a lot of people, I think, end up not really focusing on until it's too late. But we're going to show you the solution for that. Here's another comment I thought was great from a great economist, Mark Skousen. Looks like monkeys are actually beating the top economist. Monkeys outperform the index by 1.7% when they run these simulations here where these monkey portfolios are beating the generic cap-weighted index. So fascinating stuff. So here you go, folks. There's your best trader right there. And even hedge fund stars, the best in the hedge fund world, they're not always so hot at what they do either. And it turns out that sometimes random darts are beating the best hedge funds. So why is that? Well, I think part of the problem is our emotions, and that's number 3. We can relate to this comment, I suspect. All of us can. It can be expensive trying to convince the markets that you are correct. From Ed Sequoia. He's a trading pioneer for systems. You don't want to end up like this here. So we're going to hopefully help you avoid this. There's a lot of noise, we understand, and that's why we actually designed and created and built what we're about to show you. You have the bulls yammering and the bears yammering and the talking heads and pundits yammering, and that's all enough to kind of put you on this emotional roller coaster. I think we've all been on this ride maybe too many times. Even for those of us who've done it 30 years, it still happens. You get this excitement and euphoria, and then fear and depression. You raise that surrender, that white flag. Ultimately, you're probably selling the lows at that point, and then things kind of turn right around and you're back to that optimism. So we're going to try to help you with a process to avoid that. And it's not easy, folks, but sometimes our own enemy is ourselves, according to Motley Fool. There's confirmation, there's anchoring, and there's recency bias. I won't go into all of it, but I think this one little cartoon might summarize it best. So how do we feel sometimes after we have a great year of trading? You feel like sometimes you're a genius, and maybe not, but oftentimes it's simply the result of the market being very, very accommodating. And number 3, algos here. Algos have no emotion and they're dominating the landscape. 80% of the stock market is dominated with algorithmic trading, institutional firms commanding 80% of that market. Bloomberg notes here that robot analysts are outwitting humans on their investment picks. And I don't think that should be any surprise to any of us. Probably another good cartoon to summarize everything where we are now. And this is kind of going backwards in time, but here's what it used to look like, folks. This is, I could probably find some other grainy videos from my time on the floor visiting and whatnot, but this is one I took years ago. So very exciting, kind of a fun place to be as well, but believe it or not, very efficient and a very effective mechanism for trading. But with all that said, this is where we are now. Here's our competition now. This is the landscape we have to deal with. You're not really competing against others like yourself, behind a monitor or app, placing orders. This is what you're competing with. Automation, built-in risk, reward controls, no emotion. So we want to talk about options. How do we use options in that landscape? How do we compete? We want to automate our options trading as much as we can. We think a lot of smart traders are going to really enjoy looking at what we call a weird strategy and indicator. There's really no other term for it. So automated options for up markets, down markets, non-directional. We're looking at stock index futures, and I'm going to show you why. Then we have a unique indicator that puts this all together. So why an index and not an individual stock? I think it's pretty obvious. Less volatile, and we have a proprietary strategy that applies to an index and not an individual stock. And then, of course, if you're looking at an index, that's just 1 or 2 markets, not, I think there's something like 6,000 or 7,000 different securities markets now. So it makes a lot of sense to us. For example, here's the S&P 500, this line, and look at Tesla in that same period. So talk about volatility. Of course, maybe Tesla is not an absolutely fair comparison, but either way, even if you had Boeing or some other more blue chip stock, the volatility would be dramatically higher than the index itself. Now let's look at insurance companies. We talked about selling options. It's similar to what insurance companies do. They sell policies and collect premiums. They get paid to assume that risk. They're essentially selling time, managing time. They ensure themselves are always hedged. They don't leave themselves naked, as the word goes. And they're consistent in their approach. They just use probabilities, folks. That's all they do. They're looking at math, statistics, things like actuarials. They're looking at things like z-scores and distributions and on and on. And we don't need to know any of that, but ultimately it's just math. And it's the same thing with a casino. So a casino runs a business and they know all the games have odds and probabilities that favor them. So they have a much higher probability of winning than you do in the long run. So how do you be the house? So what I mean by the house, well, be the casino. And the reason why is if you bet on that zero, you're going to lose $5.26 on average if you spin that wheel 38 times. So in the long run, you're going to lose. The casino's going to win. You want to be the house. Okay, and even though you're going to have to, as a house, pay out winnings at times, in the long run, you have that mathematical edge. So we want to try to be the house when we're trading options and looking at higher probability outcomes. Looking at a baseball analogy, here's a base hit versus a home run. You don't want to go for the grand slam. It's a very, very low probability outcome. So let's look at some short option strategies where we collect premium. And you can do this in a non-directional market. And if you're scratching your head, I'm going to explain that. And then, of course, any bullish or bearish market, it makes no difference with options. They're just a tool. You can create any kind of strategy or directional bias or non-directional bias. So we're going to look at these higher probability outcomes, and all the strategies we talk about will have predetermined risk. These are called credit spreads. And if you know this, that's great. We're going to go through it quickly. And if you don't know it, it's going to be simple. And then we're going to get to really something unique that probably you have not seen before. So these are all insured positions, predetermined risk and reward, like I said, and they can be non-directional in nature. Now here's a graph, and don't worry if you don't know what it means yet, but there's a wide margin of error. You can see when this trade, let's assume the market was right here, just above 4,200 when this trade was placed. So here's the upper boundary of the trade, and here's the lower boundary of the trade. So you have this very wide margin of error where prices can move. And let's talk about how that works. We're going to look at the Greeks. And once again, this will go quickly. It's really, really simple. It's a simple, effective way to look at just two Greeks. We don't need to go into the weeds, and it's just not necessary. One is delta. What does that mean? It's the approximate probability of an option expiring in the money. So really, that's how we view delta, and that's really the best way to look at it for our purposes. For example, if the delta is 0.25, that means there's a 25% chance that option will expire in the money at that moment when it's 0.25. 75% chance of expiring worthless. So if there's a 25% chance it's in the money, then the converse would be 75% chance it expires worthless. Of course, delta is always moving with price and time. It's not static, and it is not the probability of a winning trade. So let's not make that mistake. You can't get into a trade and from the very first day say, well, this has, X probability of winning. That's not what delta represents. Now, how about theta? Sensitivity to time is all it means. Remember, options are a wasting asset. They have limited life. So theta represents time decay. It's a negative number. It equals 1 day of time decay. For example, if the option's 10 points and theta is negative 0.05, well, the next day you're going to have theta decay, and that value slips from 10 to 9.95. Then after that, 9.90, and so on and so forth. So there's really no way around theta decay. This is kind of what it looks like on a graph. As you approach time zero, you'll see the percent of the premium remaining drops and drops and drops to eventually zero. Let's look at a call spread real quickly. This is what we mean by selling a call spread or collecting credit for selling a call spread, collecting premium. You sell this 45.50 call, the red line, you collect 4.5. Simultaneously, you buy the 45.70, that's the blue line, and you pay 2.25, but the net result is you collect $112.50 minus your fees. So that's simple simple call spread. Looking at a put spread, same type of thing. In this case, you're selling the red line, which is the 36.60 put. You collect 3 points when you sell it. And then to cover yourself for unlimited risk, you then buy that 36.40 put. You pay a point for that. And the net result here, of course, is $100 that you collect. Now, these are not naked options. These are all insured. Your maximum risk is capped. So these are covered options. I just want to stress that. Not naked options like these poor critters here. And just to really stress on that, we're doing covered option spreads only, and part of the benefit, there's two key benefits. One is there's no margin calls. If you're doing uncovered option spreads, you will guaranteed end up on margin call, and then you'll end up having to close positions out ahead of time, ahead of plan, or you'll have to send more money. And of course, you also have unlimited risk when you have those naked options. So we avoid that at all costs. And if you do it long enough, trading naked options, you're going to give back all your gains. I promise you, if you do it enough. And I've seen it. So with that said, here's another spread. It's an iron condor. If you're not familiar with it, it's really simple. And if you are, I'm going to show you a variation that you are not familiar with. It's simply a combination of the put and the call spread that we just saw. And that's all it is. You just take a call spread and a put spread and you sell them simultaneously. You collect premium on the call side and the put side, and that's what it looks like. Now, here we go. We're going to reveal some people call it a weird strategy, so I just use that word. It's a high probability option premium collection strategy. It's a variation on a condor. It's called a dragonfly with 6 legs. It's for income generation, just like the other spreads we looked at. So here is our proprietary strategy. And here's what it looks like. And I'll explain this chart, and then we'll get into the demo where you can see some examples on how it really works. First of all, you'll notice the red line here has a 4 buy. That means we sell 4 of these calls, and you buy 3 further out of the money calls and 1 closer to the money call. And you notice the 1 here that you buy, in this case, is 50 points closer to the money compared to the 4 that you sold. So that means it will not lose value as quickly as the other options that are higher in strike price. So theta decay won't impact it as much, and it has a larger delta, which means it will gain in value more quickly, which is a good thing because you own it. And then you have the same structure on the downside on the puts. You sell 4 of the red line here. You buy 3 further out of the money puts, and then 1 closer to the money put. And of course, you'll see here the same thing. The 3250 put is 50 points closer to the money compared to that 3200 put. And it'll have a totally different dynamic compared to these other options. You'll notice you sold 4 and you bought 4, you sold 4 and you bought 4. So for every option you sell, you buy 1. So that means your risk is predetermined and covered. And here's another variation. You could just do instead of doing the full dragonfly, like the calls and the puts, you could do just the calls only if you wanted, or you could do just the puts only if you wanted as well. So you can just do the half dragonfly. So remember, if you're selling credit spreads, you want to end up like this guy. That's the whole idea. You want to be boring. This is not some high velocity type of trading where you're going to be, broadcasting live and, posting all your huge home runs. It doesn't work like that. And that's okay with us. Slow and steady wins the race in our view. So the whole idea is to sell these out of the money spreads and then watch time pass as you collect the premium and then manage that trade. But how would you manage that trade? How would you even know which trade to choose? That's the question I think Jackie Chan is asking. Which market are you going to do this with? What strategy would you apply? At what price? The timing. How would you even manage the risk and the profits? Well, here is the answer. It's called Theta Trader. These are pre-built option spreads. Our proprietary algo will create what we call theta trades with advanced strategy automation, bull, bear, and even non-directional markets. And then, of course, we have something to handle the managing of the trade, whether it's for risk or reward. That's called the RTI, or the risk thermal indicator, color-coded, and I'll show you that in just a second. So simple, effective option spreads with profit and risk management. So let's go ahead and jump into the demo right now. All right, great. I believe you're all viewing the dashboard here of Theta Trader. And let me expand this just a little. This is a demo account I use for webinars. And very, very simple. Up here you see the Theta trades, and I'll explain that in a second. These are any open short positions or sold spreads, like if you sold a Condor or a Dragonfly or a half or whatever it may be. And then these would be any long or bought positions. You'll notice there's only one here, and that's primarily because Theta Trader is really, we like to focus on selling premium, collecting premium, but it's not to say we don't ever buy premium. That can happen, and you see, here's one example. But let's just focus on what we just talked about. You'll notice here your account info. This is all pulled directly from your AltaVest trading account. So all this is integrated with your AltaVest brokerage account, and then any current quotes right here. You'll notice there are bullish strategies that are pre-populated, bearish, and neutral or non-directional. We're looking at the ES, the NQ, and the RT, and those are all E-mini, S&P 500, NASDAQ 100, and Russell 2000. So we mentioned why we trade the index, and towards the end of the demo here, after we're done with this, I'll show you why we specifically trade these three markets, these E-minis. But with that in mind, let's look at a Condor. So here is what the Theta Trader algorithm has done for us today. It's pre-populated and automatically generated these trades for us. They have anywhere from 17 to 66 days till expiration. And the strike prices are already chosen, the expirations are chosen, and all the valuations and everything, and I'll show you in just a moment. You'll notice this is your maximum profit at expiration, and this is called your targeted annualized return. And use that number to compare one trade to another. Quite frankly, it's not realistic. You're not going to place this trade and every 17 days place the same trade over and over for a year and get 140% for the year. It doesn't work like that. So simply, you just want to look at this. You'll notice the trades that have the lower days till expiration will always have the higher annualized return. Obviously, it just assumes you're rolling that trade over and over and over for the year. But really use that number just to compare one trade to another. That's all. Now, with that said, let's drill down further. And here's the first thing I like to do. Let's look at a graph. There's like taking a helicopter over the market and flying over, and this is what the landscape looks like. Here's the current price of the market. You're selling this out of the money call spread and out of the money put spread, collecting net premium on both sides, and that's what it looks like. You can look at the calls separately. You can look at the puts separately, and then here's the whole package, the Iron Condor. And you'll notice here has 66 days till expiration, gives you the expiration date. I won't go through everything here, but One thing to keep in mind is the cash required and the profit potential, and this is your targeted return on cash, just about 11%. And then sometimes people will ask, okay, it's going to, the cash required, or let's just call it the margin deposit, to be able to hold this trade is about $900, and my maximum potential is about 100. So that seems like it's asymmetric and not so favorable. Well, here's the answer. Remember we talked about delta. The put you're selling is a 38.90 put, has a delta of 9.93. So that means there's over a 90% probability this put is going to expire out of the money. Same with the call that you're selling, 6.85% delta. So you're looking at a 93% plus probability that the call that you're selling is going to expire out of the money. So these are the higher probability outcomes that we like. We're essentially okay with the not hitting the grand slam. Let's just put it that way, because we know this has a very, very high probability of expiring out of the money. And you notice it defaults to a sell because we're selling the Condor, you're collecting the premium. Always defaults to a quantity of 1, but maybe we'll go ahead and do 4 of these, and you'll see the numbers change. And the valuation here is always chosen for you. The algorithm does all this for you, and then you go ahead and place the order, and that's it. So you can see it showing up there in the demo account. And let me jump back to the dashboard, and let's show you the Dragonfly. And then we'll look at some simulations. We can back test this. So here is a Dragonfly, the E-mini, S&P 500. We'll look at that. It's the October end of month. Okay, so you'll notice the Dragonfly structure as we saw in the presentation. And let's look at this other matrix here, and you'll see that the targeted return on cash is a little bit lower than the equivalent Condor. Remember, it was just about 10 or 11%, I believe. So now this is a little bit over 7%. And why is that? Well, remember, you are buying this call here and you are buying this put, and that's essentially like buying extra insurance against the trade going working against you. So you pay a little bit of money. It's a little more risk averse, and therefore you have to pay for that additional insurance, let's say. And you'll notice here that the delta on the puts and the calls below 10, same in this case from the Condor we looked at. So these have, once again, 90+%, 93% probability of expiring out of the money. And it always defaults to a sell, just like a Condor. And we'll do 2 of these. And you'll notice, of course, the cash required, let me point that out. If you do 1, the cash required is just about 4,600 in this case. And that's because you're selling 4 puts and 4 calls compared to the Condor, where it was a quantity of 1. And we'll go ahead and do 2. Typically, it's about 5,000 you can estimate for each Dragonfly and about 1,000 for each Condor. And we'll go ahead and leave that value there and place that order for these 2 dragons. And there they are. You can see that if you want to go back to the dashboard, there you go. There's the ones that we just placed. And let me explain all these colors. And the best way to do that is to run through this simulation here. So you can use the trade simulator and go backwards in time. And I've run through a few just to save time. So here is an example. Let's go back in time to March 4 of this year. And let's assume we placed this end of month April Condor. We'll use these buttons to go forward. You can go backwards in time. You can go all the way to the end. And let me explain here what's happening with these colors. The RTI is green. That means good, do nothing. nothing to do. The trade was a little bit negative, and that's normal when you place the trade at first because theta decay has not started working yet. But now the trade is working nicely. Let's see what happened. Now it turned yellow. That means elevated risk, but still don't do anything. The algorithm says don't do anything yet. Of course, it's getting yellow because you're getting closer and closer to the calls that you sold. And now it's orange, which is an even higher elevation of risk. You can see the P&L on the trade is starting to lose money now. And it turns green again, back to orange, green, back to yellow. And then it turns red. Too much risk, get out of the trade, take your loss and move on. Now here's the thing, this is very important I want to focus on here and make sure you're all aware. You don't have to monitor this or watch this. The algorithm will, and Theta Trader will automatically track and monitor your position for you, and when it turns red, it will close out that position for you. And I'll show you how that works and how easy it is to set that up in your account settings. But that's a huge, huge benefit. People absolutely love the RTI. They don't have to guess. They don't have to screen watch and babysit their trades. And conversely, if it's profitable enough and when the algorithm says get out, you can automate that as well. But I wanted to make that a clear point, and I'll reiterate that in just a minute. But so that's the end of month April trade for the Condor that was placed on March 4. Now, March 4, same date, end of month April, and instead of a Condor, you did a Dragonfly. Let's look at that result. Look at this. It turned blue with 38 days left. What does that mean? It means take profits. So if you had your account settings in a setup where you were having Theta Trader automatically monitor and track your positions, Theta Trader would have automatically closed this position out for a gain, a winning trade, as opposed to the Condor, which actually ended up being a losing trade. So that's a huge, huge difference between a Condor and a Dragonfly, depending on the market conditions, wherein you'll notice this particular option here, this 4160 call, remember, you bought it, you own it. So with the market moving higher, just a little bit, enough theta decay has worked and enough value was gained in this call. So it allowed this trade to become profitable to the point where the algorithm said, get out, take your money and move on. I have a few more lined up here, and why don't we go ahead and run this one. Here's a Condor. I kind of forget how these end up, so the tension and drama builds for me too. Okay, so a little bit of yellow, a little bit of elevated risk. And then look at that, starts dropping, and then here's the red RTI. Get out, too much risk, take the loss on the Condor. Now here is that same exact date, same trade on the same expiration, but instead of a Condor, I'm sorry, you do a Dragonfly. Turns yellow, a little bit of risk. Look at that, turn blue, take your profits and get out of the trade and go to the next one. So that was on February 21st. And on February 21st here, the Condor was actually still negative, losing a little bit of money. The P&L was negative. So I'm just pointing out that sometimes there are dramatic differences between the Condor and the Dragonfly. And the Dragonfly can be a lot more robust and it can weather a lot more storms than a Condor. And we'll look at a couple more. Here's another Condor. And this turned blue, and then when it turns blue, take profits, and once again, that can be automated. So with 7 days remaining, this Condor matured enough so that it would take profits. And you're glad you had the RTI, because look at here, it turned yellow and then orange. And if you were trying to trade this just sort of by your gut, you probably would have closed out that position at some point right around here and taken your loss. But with the automation and the algo telling you no, you end up turning that loser, possible loser, into a winner. But notice here, this is on June 24. Now here is, instead of a Condor, you did a Dragonfly for that same end of month June expiration. Look at that. It turns profitable on May 28. Over 3 weeks, almost a month earlier than the Condor matured. So you had to go through this whole thing here and sit on that. And meanwhile, the Dragonfly matured much more rapidly, allowing you to get out, and you had a month of time left on it, and you were able to move on to the next trade. So the Condor and the Dragonfly have completely different characteristics in a lot of these different market circumstances. And then we'll look at the Condor here again. Here's another trade into month January. Turns yellow, a little bit of risk, and then it turns red. So you take a loss, take your lump, and move on. The algorithm says get out on January 16. We'll compare that to the Dragonfly. Look at that. On January 3rd, you had several days of opportunity for the algorithm to get you out, take your profits, and move on. So those are some great simulations. We could spend a lot of time with it, but that's a huge feature here that you don't find really anywhere else in Theta Trader, and anywhere else other than Theta Trader. You can backtest option spreads and just go here to that simulation tool, and that's all you have to do. And let me show you where to, you can look at your open positions on the dashboard, or you can go here on this one screen. So it gives a summary here of all your open positions, your short positions, your bought positions, and then you can see everything here. If you want to drill down on any one of them, you could simply, oh, let's look at this here, selling these 5 Condors. And there's the history of that trade. So this was placed on August 3rd, probably just, well, all these trades are just from demos, just like I'm doing now, with really no thought at all behind any of it. And it's getting probably quite close to closing that out for a gain, unless something crazy happens. But that's what it looked like here in history. And you can go back in time and look at closed positions. You'll notice the summary here. On this page, there are 18, 16 winners, 2 losers. Your total profit here. Short positions, there are 13 winners, 0 losers. And bought positions, 3 winners and 2 losers. And that makes sense that most of the time your short positions will probably be winners compared to buying options, because those are a lower probability outcome, as we know. And if you wanted to look in the past at any particular trade, you just simply click on it and you can go see the history of it. That's what it looks like on the graph. And then you'll notice here, it was placed on June 2nd. Theta decay started to work. The RTI is green day by day. And look, turned blue, and Theta Trader said, that's enough profit. No need to hang around. Wear out your welcome and move along. Now let me point out here, this is how you do it, folks. To automate the RTI, you just simply go here to your settings and activate the risk manager, and then activate the profit directive, and it's just that simple. And you save those settings. And once you do that, you do not have to babysit your positions. So how great is that? People absolutely love that. And you'll also notice that we have something called TradeScope. It's our daily newsletter for research and technical analysis. So people use this to help inform their decision on what type of trade to place next. And you'll also notice we have something called the daily trade summary. And this gives a rundown of any trades that were filled. Yesterday we had October in the month Dragonflies filled. And we're looking here at the summary in Asia and Europe and the US, and then looking ahead as to what may be happening and economic calendar and so forth. So there's a lot of good information there as well. And we also have here a great help file. So if you're looking at, you need to brush up on spreads or terminology, whatever it may be, you want to look at the RTI valuations and settings, you can do that all here. I know I'm moving quickly, but this is just to kind of let you know what exists. We don't have to dig into all of it. And then we have tutorials. These are videos. So everything is really self-contained in Theta Trader that you would need to know. And there's education tutorials as well on options if you want to kind of review, go back to the basics. All right, and let me point out one other couple things real quickly, and then we'll jump into what might be the best feature of all. I also want to point out we were looking here at the neutral tab, so the Dragonflies and the Condors, but remember, there are bullish strategies and bearish strategies you can use. And for example, if you thought maybe the market was a little overbought, you know, here's something called a bear hedge. I'll just show you what it is. Very, very simple. You're selling an out of the money call spread, and with that money that you collect, you buy an out of the money put spread. So that's what it looks like on the graph. Theta Trader builds it for you. You can add the quantity any way you want, you know, and place that order. So we can do, Theta Trader can do a lot, but we do like to focus on collecting the premium. It's more of a higher probability outcome. And I just wanted to point that out to you as well. Now let's see, I have a bunch of questions coming in. I think I can probably get to a lot of those. And someone's asking about the Dragonfly. Yeah, I mean, of course, a couple of people ask the same question. But yeah, absolutely, there's always risk in a trade. And so when you're trading, whether it's a Condor or a Dragonfly, just because the Dragonfly might be more robust than a Condor, doesn't mean it can't ever come under pressure and lose money as well. I mean, maybe back in some of these closed positions, I'm not sure I even have one to show. But yeah, that is, you know, the answer is yes, there's always risk, and all these trades can have risk and lose money. If there wasn't a risk, there'd be no potential for gain. But let me switch gears here real quick and let me show you probably the best feature of all. Okay, so hopefully you don't feel like that was too much at once, because actually that's okay. We can make it easier. Really doesn't get any easier than what I'm about to show you. Trade alerts. These are not your typical trade alert. Let me say that again. These are not your typical trade alert. These have one-touch response functionality. You receive an alert, you simply touch accept or reject on your device. That's it. None of that nonsense about getting an email with an alert or a text message and then having to log into your trading platform and copy an alert, and hopefully you get the buy and the sell right, and hopefully you get the correct strike and blah, blah, blah. So these alerts are live, meaning they are integrated with your AltaVest account. So once you touch accept and that order is filled, everything flows through and you're filled, and Theta Trader begins tracking it, just like we saw in the demo here with Theta Trader. So here's just a short example. You get a text and you just click the link and it takes you right to the alert. Gives you an overview, a graph, telling you selling the Dragonfly, gives you the premium collected, how much cash is required, and you maybe can't see it, but it gives you the quantity. So the quantity is already pre-sized for your account. Everything is done for you. And if you like what you see, you touch accept, and that's it. The order is transmitted. We'll do it one more time and I'll be quiet for a moment. Okay, folks, there you have it. That's the demo for Theta Trader and the trade alerts. And let me show you how we can get you involved and run through some FAQs as well. I see some questions being asked and keep asking them, but I think I'm going to actually answer them in some of the FAQs. So how about a membership? We call it a Theta Trader membership. Remember, that includes what you just saw, Theta Trader, with our proprietary algo, actually creates the option spreads for you and the opportunities and presents them for you. Simple and effective trade selection. We mentioned the risk thermal indicator, the different color coding, and how it will automatically close those trades out for you, whether it hits a risk target or a profit target. That's basically putting your option spreads on autopilot. You can remove your emotions. That's how you do it. You just, where it's yellow highlighted, you just click that box. Then you have the trade simulator. You saw how that was working. We ran through some simulations and you can go back in time, and people spend a lot of time with it. It's actually quite fun and informative as well. So you have Theta Trades, the RTI, and the simulator. That software valued at over $3,500. Then you have the trade alerts that you've not seen anywhere. Remember, these are one-touch alerts. The trades are actually customized and tailored to you and your account. These are live alerts, meaning they're integrated. You just touch accept. If you want to place the order, that's all you have to do. And then from there, the risk thermal indicator will automatically manage that trade for you. That software valued at over $4,400. So remember to summarize your Theta Trader membership. You have the software itself and the trade alerts valued over $8,000. But people will say, well, what if I need a little help? Well, here you go, folks. You have, as part of your membership, a private coach. You have one-on-one training with a licensed broker who's experienced. You can do 1-hour training sessions and share the screen. The broker will share their screen with you. So you have a co-pilot. You can develop that relationship, discuss trade strategy, review your histories, whatever it may be, and the value there. I don't want to blow over this too quickly because I think it's important. At least $7,500. I talk to people all the time, and they're actually paying for tutoring and mentoring and educational services, and they're paying $25,000 and more. And that's okay if they're getting value out of it. But what we're saying is we include what you need to know to use Theta Trader. That's all part of your membership. So again, the software, the alerts, the coaching, $15,500 value. And there, of course, let's not forget the proprietary research. It is important, that I think people pay attention to market conditions and some of the analysis that we're pushing out, and our clients love reviewing this material. That proprietary research valued over $2,900. And of course, the online videos and tutorials I mentioned, that's all embedded in Theta Trader. So to summarize, you have over $18,500 value with your Theta Trader membership. And I am confident that Theta Trader can be that one tool. If you're trading options, it's really that one tool that could save you a lot of time. You can cancel a lot of other subscriptions. I think it can lower your stress and aggravation levels. That was the whole idea. We've had thousands of clients trading options over the years, and everything kind of came down into Theta Trader. So all of that knowledge we gained, and all of the, I guess you could say, those hurdles people were having, that's what we wanted to do, is approach and really resolve those types of dilemmas, and that's what Theta Trader does. So we think the answer is yes, it could be the tool for you. And like I said, people are paying tens of thousands of dollars for not only coaching, but for other software. And I can say that because I've done it, and I talk to people who tell me that. So I get it, and if you're one of those people, that's okay. But I think Theta Trader might be exactly what you've been looking for. When we go out and live presentations, we offer Theta Trader. In the past, we've even had it offered at a higher price, and people go to the back of the room and line up and sign up. But of course, we're doing this online, so we can bring it to you for less cost. And in fact, what I want to do here is make it 80% off. And I try to do this. We can't do it all the time, but we do live presentations online. This is a live webinar. One-time payment of only $597. That's your Theta Trader one-time payment. That's lifetime membership. We've been here since 1997, folks. So there you go, lifetime member, cf.altivest.com/TT. And that's my direct phone number. Of course, you can call anytime, but of course, at the moment, I'm talking right now, so it'll go to voicemail. But leave an email message for me, phone message, whatever, if you need some help or comments or questions, that's fine. But really, most people just go right to that form. And here, really, there's no excuse. Let's not procrastinate, because I know what happens. We all get sidetracked. Just jump on that form right now. If you think it's for you, you're not 100%, maybe you're 99% sure, just sign up. And there's a 30-day guarantee on that rebate for that membership fee. So really, you have no risk on that membership fee. If you sign up and something happens, and I know life sometimes takes us in different directions, that's okay. No one's gonna break your arm and force you to be a client. Force you to be a client. We want people who are happy with us. So, but yeah, let's go ahead and get you signed up. cf.altivest.com/TT. Now here's the thing too. People love to take us up on this offer. You deposit $100,000 and then we'll simply rebate that membership fee. So keep that in mind. People like that offer as well. Couple comments and questions here in the Q&A. How do you lower your tax rate by over 10%? Well, if you trade futures and options, they're tax efficient. They're what's called 1256 contracts. If you're not familiar with that, they're simply treated differently. Your gains and losses are treated differently than compared to securities. So if you're trading individual stocks, you have a $100,000 making account with 20% return. That's a 12.6% rate of return. If you're trading options with us, that's a 14.64% return, simply because you're trading futures options. There's a big, big difference, folks. Tax efficiency. And there's no more itemizing. You just get your P&L, one number, and that's all you would need with your 1099 to do your taxes. And then here, why the E-minis? They're liquid, efficient, and cost-effective. And this is kind of an interesting one that most people have no idea. The E-mini S&P 500, just that one market, it outtrades all ETFs around the globe by over 2.5 times in terms of average daily dollar volume. I bet you didn't know that. So that's a good one. That's why we're in this market, folks. And it's also 10 times bigger than the SPY. So you think the SPY is where everyone's trading? No, they're trading E-minis. That's where you want to be. There's advantages to trading the E-minis: large volume, liquidity, easy access. Here's July average daily volume, 1.338 million on the E-minis. Superior execution. They offer a cost savings of $4 to $15 per contract. So with all that liquidity, that means tighter and tighter spreads. That's what that means. Better execution. And here's another thing. When you're doing the Dragonflies that we talked about with Theta Trader, you should understand that that's all done as one order. Those 6 different strike prices are traded at one price. They call it an object. So if you do it with stocks, and I've seen it, and I've even tried it, and I've seen people online trying to do it, you cannot place a Dragonfly order. You have to do it as 2 separate orders. So you're legging in, and it's a nightmare. And it gets tracked separately. So you want to do this in the most efficient way possible, and that's using these E-mini options. So whether it's the ES or the NQ or RTY, that would be the NASDAQ or Russell, the minis are where it's at. And why is that? Because there's 30 market makers supporting prices, actionable liquidity, and these all trade electronically on the Globex exchange at the CME group, the largest futures exchange in the world. The ES options, they have the largest market share, densely packed strikes, more than 100 annual expirations, ensure granularity and coverage. What do I mean by that? Here's a good example. If you're trading, let's just say it's a Condor or a Dragonfly, and here are your sold calls up here and your short puts, and some time goes by and you want to place another trade. So here are the puts and here are the calls, and some more time goes by and you want to place another trade. Well, the strikes have to exist. They have to exist. If you go far out in time and you're far out of the money, if you're trading other markets, the strike prices don't even exist. So that's why you need to be in this market. And here's another reason. How about just tracking, like I showed you, the 2 or 3 E-mini markets and not thousands? And what about the efficient margin versus stocks? Absolutely more efficient with the inherent leverage in the futures markets. And then there's a clear cost structure. Here's something a lot of people don't know. What am I talking about? These are not securities options. Remember, we are talking E-minis at the Globex exchange. That's an electronic exchange for all orders, large or small. Every order is treated the same, whether it's big, middle, medium, or small. So every order gets equal treatment. There's no payment for order flow ridiculousness like you have when trading stocks. You're trading on your, whatever stock trading app. And let's beat up on Robinhood because that's the SEC already did. But you're getting inferior trade prices. They say, hey, it's commission free, but who cares? You're actually losing more money on your trades. And they get fined by the SEC. People think they're saving a penny, but they're really losing a nickel. So it's called payment for order flow. So when you're placing orders through any brokerage firm that says free commissions, they're not filling your order. A third party market maker fills that order. And why do they sell that? They sell that order flow. And that entity like Citadel that buys the order flow, why are they paying hundreds of millions of dollars to fill those orders? Well, because they can fill them at less advantageous prices. They can basically take the spread. So just want to point that out, folks. So nothing of value is truly ever free. I think we've probably heard that throughout our whole lives. At least I have. So here's the question. People ask, what are the commission rates? Our rates are competitive, 5 1/4, and that's round turn, all in. So here's an example. I copied it right off of a big brokerage firm's website. They say their fee is only 2 1/4, but that's per side, and then they don't include the clearing and exchange fees. But when you can't avoid that. So when you add that all up, it's higher than what we charge. So our rates are very competitive. And I want to also point out that everything that you saw in Theta Trader is net of trading cost. All the percentages and dollar figures performance is net of trading cost. And of course, everyone has different trading performance because everyone places trades differently. What size of account? Well, if you want to have multiple option spreads going, you probably need, 25,000 is the minimum. And we suggest 50 to 100. And of course, you can do an IRA, individual, joint, corporate, LLC, trust, any of those works well. A lot of people want to do IRAs. There are some financial requirements. and perhaps experience too, but there are definitely some benefits with the IRA, self-directed. Forbes says here it can diversify a portfolio by adding investments with a low correlation to stocks, help control volatility and limit downside risk. Here's another article that says may improve diversification, lower portfolio risk, and alternatives can help smooth the impact of market volatility and generate higher returns. So on that note, I think what they're trying to say is, here's the S&P 500. You think you're really diversified, but really almost all the market cap is in just a handful of stocks. In fact, the top 5 make up over 22%. I think it's a little higher. I think this is from last month. And that'll probably continue that way for a while. But if you want to do something a little different, something that's non-correlated, here, look at the total market cap to GDP or valuations at record high. This is the what they call the Warren Buffett indicator, basically pointing out that market valuations are high and getting higher at record highs. Here's the CRB index. I guess you could call that no other word for that but inflating or inflation, even though the Federal Reserve says it's not. But Fed monetary policy, that's been their whole goal, is to inflate asset prices. It's been working. But meanwhile, July consumer prices jumped 5.4%. Crazy. Used car prices a couple months ago, look at that. The Federal Reserve says, nope, I don't see any inflation, like the 3 blind mice. And we're going to hear from Powell on Friday. So who knows what he'll say, but I imagine they won't want to be the ones to say anything to rock the market. So we shall see. Consumer prices surged the most in June since 2008. Used car prices breaking 10-year record. Anyway, so here's the Theta Trader membership. It's the algo-driven options trades, pre-selected trades, automated trade exits with that RTI. You have those one-touch trade alerts, then that personal coaching provides you what you need, takes some of the weight off your shoulders. This is a great cartoon. This guy says, when it comes to investing, I always trust my gut. Well, you don't want to do that. We're not doing that. We have a process. We use technology, and we built out a process to remove your gut, remove your emotions, and use some math and probabilities. We think it's the best way to trade options with these types of strategies. So here we go, folks. That's the last slide. You got that membership available, $597, one payment. You want to get it before it expires, and you can certainly reach out and call us if you have any comments or questions, or just go right to that page and sign up, and we can talk to you, and then we'll get you the link for the electronic account application and go through the onboarding process, very similar to any other brokerage firm. And if something happens in the next 30 days, you change your mind, that's fine. You let us know. We'll just refund that fee, and life goes on. So let's see if there's a few more questions. Let me see if there's, you know what I'll do here while I've got this up. I will send the link here into the questions. Okay, so I just sent the link, put that in the questions field. Yeah, and once again, no, yes, someone asked about an account that unfortunately, we're not able to work with Canadians. I would love to, but we can't unless you have a legal U.S. residence. It's a compliance thing from way above us regulators. The same thing with the EU. And 25,000 really is the minimum for Theta Trader. Yep. It's just the way it works in the strategy. It doesn't work well. You'd be limiting, and we just wouldn't want to see you limited with what you could do. And let me jump here, a couple other questions. Yeah, I think someone says with 100,000, what can you do? Well, I think you can be very well diversified. among the strategies. So you may have a couple different Dragonflies and different expirations. You might have a few different Condors and different expirations going. You might even at times have a half Dragonfly or something like that happening. So you can get yourself diversified among different expirations and different strategies, and even not just in the ES, because sometimes we'll of course trade the NASDAQ or the Russell, and they can move quite differently. I mean, look at the Russell um, last week or two, just fell like a rock, and now the last 3 or 4 days, it's bouncing pretty hard, but still nowhere near its all-time high like the NASDAQ and the S&P 500. So it's good to have exposure across all those different indexes. And let's see here, someone else asked about why. Yes, well, we're only trading the stock indexes that you saw in the dashboard there. So that doesn't mean we can't trade other markets because we are a brokerage firm. It's just Theta Trader is only designed, and that's a good question. Theta Trader is built to trade what you saw, but if you have an account with us, and some people want to do other things, yeah, certainly. Some people want to trade gold futures contracts or even gold options and do it a completely different way, and that's fine. We just do that with a separate platform, but that would not be through Theta Trader. Most people just get involved with us and want to use Theta Trader and stick with that. All right, well, great. I think the other questions I've answered already. And yeah, so yes, that's great. Give me a ring. If I don't pick up, I'm on voicemail. And go right to our link, sign up. We'll get you started. And don't procrastinate, because I know how it is. I do the same thing, and you think, oh, I really should have done that. But if you want to make something happen, just this is the way to make it happen. Do it now, and love to hear from you. And I can't tell you how many people love those trade alerts too. So I think it'll kind of transform the way you do things and give you some additional free time and take the weight off your shoulders. So, all right, great, everyone. Thanks for joining us, and we'll talk to you soon. Bye-bye.